Next, coming back to the debt, is it right? To the debt. See here they have mentioned what? They have mentioned redeemable share preference share capital. Is it right? Redeemable preference share capital, and they have talking about what? They are talking about 10% loan notes. Is it right? 10% loan notes. Fine. Now, is it right? Now, profit before tax is how much they have mentioned? Fine. Okay, no, okay, no problem, nothing. Is that now what happened? Debt is nothing but if you take into consideration that, is it right? They have taken the debt. Debt is how much? Here we have to see, usually in normal situations, whenever they gave you preference share capital and the loan notes, preference share capital, normally in normal circumstances it has to be next to equity. Okay, if it is next to the equity, usually it will be added to what? It will be added to debt, because it is not on par with equity at any point of time. It cannot be equal to equity share capital at any point of time. Okay, it cannot be equal to share capital. If that is the case, what we have to do? We have to make it sure that it is a redeemable. Is it right? It is a redeemable preference shares. Is it redeemable preference share capital? How much is the redeemable preference share capital? Redeemable preference share capital is 50. Is that plus? Is it right? 10%. Is that 10% loan notes? Is that 10% loan notes? How much is that 10% loan notes? 150. Total it comes to how much? Total it comes to how much is the total equity? Total equity is 1700. Total debt is how much? Total debt is going to be, now gearing ratio is right? Gearing ratio is how much? 200 divided by 1700. How much you'll get?
Zero point 0.112.
0.12. Check again. 200 divided by 1700.
0.117.
0.0.
117.
Okay. 0.117. Okay, or 11.7. Is it right? What mistake we have done? What mistake we have done? We did any mistake or we didn't know any mistake? Is it right? With respect to this, is it right? With respect to this gearing ratio, is it right? Gearing ratio. How much is the debt? Debt is 200. Is it right? Debt plus equity. Is it right? Debt plus equity. We did little bit fast. Okay, we did little bit fast. Is it right? Debt plus equity. Is it right? How much is that? It is going to be how much? 200 divided by 1900. What is the answer you'll get?
0.105.
0.105 or 10.5%. Okay. Next, what they are asking us, what is it clear about this?
Yes, it's
Next,
clear.
is that it's see, this chapter is very easy, is it right? Only thing is we have to be, it is time consuming, okay? It is little bit time consuming. What they are asking us, they are asking us to calculate return on capital employed, is that they are asking us to calculate return on equity, is right? Return on capital employed, return on equity. What is the formula for return on capital employed? Tell me fast. ROCE. PBIT, profit before interest and tax, divided by capital employed. Okay, divided by capital employed. Profit before interest and tax is how much? They have given here profit from operations. Is that profit before interest and tax? Is it right? Profit, this is profit before interest and tax. Is that this is profit before interest and tax? Is how much profit before interest and tax is? 400. Is it right? Capital employed. Is it? Capital employed. How much is the capital employed? How much is the capital employed?
1,700.
1,700. Is it right? If you take into consideration, is it? It is 1,700. If you take into consideration, this is the equity. Is it right? This is the equity and this is the capital employed. Fine. How much you will get? 400 divided by 1,700.
0.235.
0.235. Okay, or 23 point. The formulas will never change. Okay, never ever change. Only the thing is the information will be plus or minus. As simple as that. Is it? Return on equity. Return on equity is what? What is our formula for return on equity? What is the formula for return on equity? See, profit after tax divided by total equity. Is it right? Profit of, here we don't have profit after tax. We don't have tax here. Is it right? It is otherwise called as profit after tax. Okay. This is otherwise called as profit after tax. How much is the profit after tax? 350. How much is the equity you are having? Equity is having how much? 1,200. What is the answer?
0.291.
0.291 or 29.1%. Is it right? 29.1%. This is 23.5. This is 29.1. Is it right? So if you take into consideration, this is 29.1, 23.5 and 29.1. Is it right? What is the formula for the quick ratio? Quick asset ratio is nothing but current assets minus inventory. Is it right? Current assets minus inventory divided by current liabilities. Is it right? Current assets minus inventory divided by current liabilities. Now, is it right? Current minus inventory. Now, the acid test ratio or quick ratio should include, is it right? Should include what they are saying. They say that should include should include what? Which one we have to include? Raw material?
Trade
Huh?
receivables. Trade receivables.
Why trade receivables?
Because it's current asset.
The acid test ratio or quick ratio should include what? Should include or, is it right? Or if you take into within this, okay, within this, what we have to do in the current assets? Current assets will have inventory, is it right? Current assets will have inventory, current assets will have receivables, current assets will have cash, is it right? If within these factors, which one is relevant to us? It is trade receivables, is right? Current assets minus inventory, or we will never write like this. We never ever write like this. We only write in the way how we will write. We will write like current assets minus inventory. Is it right? Current assets minus inventory. Okay. Next. Latham PLC recognized an impairment loss in relation to property, plant and equipment in profit and loss account during the year. What was the effect its recognition on Latham's gearing and non-current assets turnover ratio? Is it right? Non-current. What happens on the gearing? Is it very practical? Gearing is what? Gearing is nothing but debt divided by debt plus equity. Is it right? Debt divided by. What happens if there is a impairment? Is it right? If there is a impairment, what will happen? The profits will decrease. Is it right? Profits will decrease. Profits decreasing, what will happen? Retained earnings will decrease. Is it right? Retained earnings will decrease. In the gearing, is it right? In the gearing, what we are doing? Very, very analytical one. See the thing. In the gearing, total equity is what we have done in the equity plus retained earnings. Is it right? What we have done in the previous case when we have calculated equity? When we have calculated equity is nothing but the ordinary share capital plus retained earnings. Is it right? Now, what happens if is it right? What will happen? Is it right? It will decrease the retained earnings. Is it right? Now, is it right? It decrease the retained earnings. Now you see the things. Is it right? Normal case. Is it right? In a normal situation. It is in a normal situation in the case of impairment. Is it right? In the case of impairment. You unless until you don't do like this, you will not understand. Is it right? Normal situations. Assume. Is it right? How much is the equity? Debt equity is how much? Equity is, take example, 2000. Is it right? Retained earnings is how much? 500. Is it right? And the debt is how much? Debt is going to be, assume debt is going to be 800, not 800, 1250. Okay. Now, if you take into consideration to 1250 divided by 2500, it comes to how much? 0.50. Okay. Now, what effect is having? Now, if you have the equity, how much equity? 2000. Impairment. Is it right? Because of impairment, what will happen? Retained earnings will decrease. Assume that retained earnings has been decreased by how much? 250. Is it right? Retained earnings has been decreased by how much? 250. Debt will remain same, 1250. Is it right? Debt will remain same. Now, if you take into consideration What happened? 1250 divided by 2250. How much we'll get? One minute, please 1 minute. 1 minute. Again, we are doing the same mistake here. Is it 1 minute? Is it again 1 minute? 1 minute. It is debt plus equity, okay? Debt plus equity. How much is the debt? 1250. Is that 1250? Here, how much is the debt? 1250. Debt plus equity, okay? It is not only debt, it is debt plus equity as such. Is it? It is debt plus equity as such. Now 1250 divided by how much? 3750. 1250 divided by 3500. Tell me now.
0.33.
0.33, and here
0.35.
0.35. What happened? Gearing ratio. Gearing ratio has been increased. Is it right? See, a gearing ratio has been increased. Fine. Now we have to eliminate it. Is it right? Gearing ratio means this is not there. No change in gearing. No. No change in gearing. These two options are eliminated. Okay. These two options are eliminated. Now we are talking in terms of what? We are talking about the A and B. Okay. We are talking about the A and B. Now net assets turnover. Is it right? See what happens. As simple as that. When there is a impairment, is it right? When there is a impairment, is it right? What happens to net assets? Net assets will decrease. Is it right? Net assets will decrease. Yes or no?
Yes.
Is it right? Net assets will decrease. Now, if net assets are decreasing, is it right? If net assets are, again I will put example for you. It will be easy for you to understand. Is it right? It will be easy for you to understand. 1 minute. Is it right? What happens? See the things. Net sales. Is it right? Net sales divided by what? Net sales by average assets. Average total assets. Is it right? Average total assets. Fine. Now see, make it a point. Again, make it two situations. Is it right? One is normal situation. One there is a impairment. Is it right? One there is a sales will be same. Assume sales will never change. Sales we have to be constant. Okay, sales will be constant. Net assets is right. Net assets. How much is the assume net assets going to be 3000. Impairment net assets going to be how much? 2600. Okay, sales will assume sales is going to be how much? Assume sales is going to be how much? Sales going to be 6000. Okay, sales will remain same. Okay, sales will. Now you apply the formula. Is right? You apply the formula. 6000 divided by 3000. It comes to how many times? 2 times. Is it right? 6000 divided by 2600. It comes to how much?
$2.3.
2.3. Is it? 2.3 times. Now what's happening here? Also the net assets turnover ratio is increasing. When it is increasing? When there is a impairment. Is that? When there is a impairment. The answer is what? A or C?
A.
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 Is it right? The answer is what? The answer is A. Like this, you have to see, you have, unless until you don't put numbers, you cannot get the answer. Is it right? So there is no point of memorizing and putting the things and getting the solution. So if I say that it will increase the ratio, you will ask me how it will increase. You have to prove, yes, that if this is the case, here there will be increase. If this is the case, here there will be a increase. Okay. Next. Operates a highly seasonal industry. An analyst has sought to assess JT by comparing its ratio to ratios of the business sector average for the year ended 31st December 2003. Which of the following is likely to be a limitations of this ratio analysis? See what they are saying. They are saying it's a seasonal industry. What does it mean? Any idea about this? Seasonal industry?
No idea.
Salala is a seasonal industry. During particular season, people will go. Is it? During particular season, the demand will be more. Is it right? And during off season, the demand will be less. Is it right? Dubai festival is a seasonal industry. Is it right? During Dubai festival, people will go more. Is it right? It's every year. It should happen every year. It's not happens once in a, not like a Qatar World Cup. Okay? Not like a Qatar World Cup. It has to be happen every year. The best example is Kharif in Dhofar. It is a seasonal industry. Is it right? Now, when it is a seasonal industry, what will happen? Is it when it is a seasonal industry? Is it when it is a seasonal industry? Is it when it is a seasonal industry? What will happen? Assume, take the example of Dhofar. Is that Salala? You will understand really good. January to March. Is it right? You will say April to June. Is it right? You will say July to September. Is it right? You will say October to December. Is it right? What will happen? Here the business will pick up. Oh, slowly. Okay, June. But the moment you will have in July to September, the business will be huge. Is it right? And slowly and steadily, is it right? The business will be less. Here, more or less, the business will remain same. Is it right? Is it? The financial means what happens? Which of the following is likely to be limitation of analysis? The average figures have been taken from the entity whose year ends occur at different points of time. Got my point? The average figures have been taken from the entities whose year ends occurs at a different point of times across the year. Is that what happens here? Here the performance is different. In the second phase the performance is different. In the third phase the performance is different. In the fourth phase the performance is different. We will come to that. I mean what they are saying in the first option, when we are talking about, we will take the average. Is it right? We will take the average as such. The industry has experienced significant falls in demands over the past 2 years. See, we are not. They are saying that analysts sought to assess by comparing its ratio to ratios of the businesses. No, we are not talking about the past 2 years. We are comparing we are comparing with the company. Is it right? We are comparing with the company and we are comparing with the industry. Is it? Always make it a point whenever you are making an analysis. Is that this is the company performance, firm's performance. Okay, You are talking about the company and you are talking in terms of the industry also. Is that there should be a uniformity, there should be a comparison. You always compare January to March what happened in industry, April to June what happened to industry. Like this you have to make a comparison. You are not comparing, never in the case we are going to compare for 2 years of the same industry. All the entities in the sector prepare financial statements under IFRS standards. Is it? All what they are saying, all the entities in the sector prepare financial statements. See, that is not the case as such, is it right? There is no blanket rule that all will prepare. It's subject to the capital, it is subject to the registration, it is subject whether it is a listed company, not listed company. Is that there are so many things that has been attached to that. There is nothing. That's not a limitation. Is it right? There is not a limitation. It is not a limitation at all. It is favorable. Is it right? If you take into consideration, this is a positive point, but not a negative point. Is it right? Is that? But not a negative point. The industry has experienced significant falls in demand over the past 2 years. Again, it is not related to the things as such. An error was discovered relating to financial statement. This was corrected fine. Error happened and you are correcting, you are making a correction, and this is not a limitation. Is right? What is the limitation? Seasonal industry. Okay, seasonal industry. What is the limitation? Limitation of the seasonal industry is one specific period. Is it right? On one specific period. Is it? I'm writing here one specific period. Is it? The performance will be best. Is it? The performance will be best. Is it? This is one of the will be the best of the best. Is it right? During other periods. Is it? During other periods. Is it? The performance is lacking. Is lacking. LACK lacking means it is falling behind. Is it right? It is falling behind as such. Is it? What they say, the average, this is one of the limitation. Is it right? What is the limitation? The limitation is we are taking the average of different points. Is it right? We are taking the average from different points. In one case it will be really the best of the best average. It goes up. Is that in some cases it is not, slowly it will, in some cases it will remain flat, in some cases it will decline. Is it right? This is the moment you should understand. See, that is what we are talking about analysis. When you are doing the things, you should have your own assumptions. Is it right? You should have your own assumptions as such. Is it clear? The answer is?
Yes, it's clear.
The answer is? Tell me.
A.
A. The following information has been taken from the accounting records of Excel for the year ended 31st December 2004. Fine. Now, working capital cycle is how much? 55. Is it right? Working capital cycle is how much? 55. Payable payment period is 40 days. Credit sales is 2 million and year-end receivables are how much? 274. all calculations should be made to the nearest full day. The trading year is what they are saying, what is the inventory turnover period. They have given us inventory now. They gave us inventory to us. They didn't give inventory. Is it right? They didn't give inventory as such. Is it right? Now, I will just go back. Is it right? We have done some way. We have done this formula some way. Receivables, payables, percentage inventory, over trading, investor, okay. We have done, somewhere I have explained you this formula, okay? Somewhere, fine, no problem. I will write it again, okay? I will write it again. Okay? No. Now, what they are asking us, what is the inventory turnover period? Is it right? Now, what they have mentioned, they said working capital. Is it right? Working capital cycle. Is it right? Working capital cycle is nothing but inventory turnover period. Formula is this one. Is it? Inventory turnover period. Is it? Plus receivables. Is it? Receivables collection period. Receivable collection period minus payables payment period. Is right? Minus payables payment period. Fine. They have we have working capital cycle. How much is the working capital cycle? Working capital cycle they gave us. Is it right? How much is the working capital cycle? 55 days. Is it right? They gave 55 days. And they gave the payables also. Payables are how much? They gave 40 days. Is it right? They gave 40 days. They have not given receivables collection period. Is it right? We will calculate receivables. We'll calculate receivables collection period. Is it right? We calculate receivables collection period. What is the receivables collection period? Receivables collection period is nothing but receivables divided by sales times 365. Is that times 365? Receivables are how much? 274. Is it right? 274. And sales is how much? 2 million. Is it right? Sales is how much? 2 million into 365. How much you'll get?
50.
How much? 50. 50 days. Okay. Now see the things. I'm writing again. Okay. Working capital cycle. Is it right? Working capital cycle is equal to what? Inventory turnover. Is it right? Inventory turnover period plus receivables turnover period, collection period, sorry, receivables collection period is it receivables collection period minus payables payment period. Is it right? Payables payment period. Now they have given how much? This is 55 days. Is it right? This is 50. We don't have. Is it? We don't have inventory turnover. Is it right? We don't have inventory turnover. Is it? We don't have inventory turnover period. Plus receivables are how much? Receivables are 50 minus payables are how much? Payables are 40. Is it right? Payables are 40. Take inventory on inventory, okay? Take inventory on the left hand side. Is it right? Inventory turnover. Is that inventory turnover period? If you take left hand side, what will happen? Sign will change. Minus, okay? Equal to. If you take equal to 50 minus 40, is that 50 minus 40? It will come on the right hand side. Is how much? 50 minus 40 minus 55. Okay? 50 minus 40. How much will get? 50 minus 50.
Minus 45.
How much? Minus 45. Is it right? Minus inventory turnover. Is it right? Minus get cancelled. Okay? Minus get cancelled. Is it right? How much is there? How much is there? Inventory turnover period is how much? Inventory turnover period is how much? 45 days. Are you okay? Is it clear?
Yes.
Fine? Now, my suggestion to you is, till the examination, one day before, till the examination, at least give 2 hours. We will do practice. Okay, we will do practice. 2 hours. I am not talking more than 2 hours. 2 hours. We'll do anything. We will do randomly. If you find anything difficulty, we do that, or we do randomly, so that we will not waste time. Only I am asking 2 hours. One day before I will leave you. Your convenience. Okay?
Okay.
Now, incorrectly treating a lease rental as an operating expenses is likely to have impact on what type of ratios? Incorrectly treating lease rental. Lease rental is nothing but operating expenses. Is it right? If operating expenses, is it right? If operating expenses, if operating expenses, is it right? If operating expenses is less, if you are treating wrongly, is it right? If our operating expenses will be less and the profits will be more, is it right? And profits will be more. This happens where? This happens in the income statement. Okay, this happens in the income statement. What happens with the financial position? Is it right? What happens with the financial position? In the financial position, what will happen? Definitely your assets will increase. Is it? What will happen? Your assets is increasing. Is it? The assets will overstated, will increase. Is it? When the assets will increase, is it right? When the assets will increase, what is the thing? non-current asset ratio will be understated, interest cover will be understated, return on capital employed will be understated, gearing will be understated. Is that we want to know what will happen? Is it right? Gearing will be understated. Is it when we are doing the things? Is it when we are doing that? What will happen? Profits will increase. Is it right? Non-current. We have to make sure non-current assets turnover. Is that non-current assets turnover? We have to. What is the formula? You have sales divided by non-current assets. Is that right? Next, interest coverage ratio is nothing but profit before interest and taxes divided by interest expenses. Is that interest cover ratio? Is it right? Profit before interest and taxes divided by interest expenses. See, why they have given all these problems is we have to make sure that we will have a complete understanding about the formulas. Return on capital employed, profit before interest and tax divided by capital employed. Is it right? Next, gearing ratio. Gearing ratio is nothing but debt divided by debt plus equity. Okay, just I will go through what is the interest coverage ratio. I just want to reconfirm. Okay, I want to reconfirm. Profit, yeah, exactly. Profit before interest and tax divided by interest payable. Right. Now what happens? See the things. Incorrect treating a lease rental as an operating expenses. Incorrect treating a lease rental as an operating expenses is likely to have impact on which ratios? We have done. Okay. If incorrectly treating it as a operating expenses, what will happen? Operating expenses will increase and the profits will what happen? The profits will decrease. Okay, the profits will decrease. See, what is the rule of lease rental? You have any idea? We have done in lease. What is the concept of lease? Have you have any idea? What is the concept of lease and rental? What is the Are you there?
Yes.
Yeah, tell me what is the concept of lease rental? Yes or no? You otherwise I will explain you. Don't worry.
No.
Yeah, fine.
No.
Good. See, we have done lease rental. Is it right? What we have done in lease rental, we have done in the lease. It is almost a revision of that. Okay. Here just I am putting it a small. When we calculate lease, is it right? We calculate the opening balance, we will calculate the interest, we will calculate the payment, we calculate the closing balance. Is it right? We calculate 1, 2, 3, 4, 5 years. Now what is that? The closing balance is, we add whatever the first year, second year, whatever is there. If there is anything which is going to pay for the next 12 months, that is going to be identified as a current liability, and beyond 12 months that is going to be identified as a non-current liability. That is going to be identified as a non-current liability. Is it? That is the difference. That is the significance of the lease rental. Incurred, how you have to treat lease rental? You cannot put it in operating expenses. Is it right? You cannot put it in operating expenses. Subject to the condition. Subject to the condition how it is going to be applied, we have to treat it accordingly. Fine. That is the reason we are putting that we have the how much it has to be paid for the next 12 months. Is it right? Now, when we have incorrectly treated the lease rental as a operating expenses, how it will have impact on the financial ratio analysis. Which ratios they have given us? Is that they gave us the things. Is it right? If what will happen if it is treated as operating expenses, is it? If it is treated as operating expenses, which ratios will get affected? Is that if it is treated as operating expenses, profits will decrease. Is that when profits are decreasing, is that what happens to the things? Your retained earnings will also decreases. Is it right? Profits are decreasing, your retained earnings will also decreases. When your retained earnings are decreasing, it will have impact on where? It will have impact on capital employed. The capital employed will also decreases. Is that the capital employed will also decrease? What is the components of capital employed? The components of capital employed is what? The capital employed. What is the formula for capital employed? Profit before interest and tax divided by equity plus debt. Okay, equity plus debt. Now, is it? Now what happens? Definitely, is it? Your capital employed will also decreases. Fine. How we are working with the capital employed? See, very you have to you have to make a thread about this. Is it right? If you have two approaches. One approach is we are talking in terms of the equity approach, and another approach of capital employed is what? You have the total assets minus current liabilities. Is that you have total assets minus current liabilities? Fine. Is that total assets minus current liabilities? Now, which one is going to be affected? That's very important. Or it is going to be, see, all are related. Is it right? All are related. Your non-current assets ratio will be, what we have to understand is which will be, whether it will be understated or not. This is more important. Okay. The concept is which one is understated. When the profits will decrease, retained earnings will also decreases. When retained earnings will decrease, what will happen? the total equity will also decreases. Is that total equity will also decreases. Now, when we take the things, is that we are understating. Is that which one we are understating? We are understating equity. Now, which ratios are they? See, you have to mention where are the equities are there. Is that where equity is involved? Equity is involved in where? Equity involved here. Is that equity is involved here? Fine. Equity is involved in the return on capital employed. Equity is involved in gearing ratio. Now, what happens? Just now I told you. Is that what I told you? That it will have impact on what? Non-current liabilities as well as current liabilities. Is that non-current liabilities and current liabilities? Is it lease payments? Is that you have to identify. Now, when we say non-current liabilities, debt is nothing but a non-current liability. Is it? Debt is nothing but a non-current liability. See the thing. That is the reason you should have a very clear understanding that what are the things it's affecting? It affecting the debt, because debt is also having the non-current liability. Now, what happens? You have incorrectly treated as a lease as a rental, as a operating expenses. When it has been treated as a operating expenses, your operating expenses will increase, your profits will decrease, your equity will decrease. Is it right? Your lease rentals, automatically what will happen? The debt component will also decreases. Just you are incorrectly treating a one expenses, it will have impact on other expenses, other elements too. We are not talking about the sales, is it right? We are not talking about the sales. Sales is nowhere involved here. Profit before interest tax, interest is involved, is that? Profits are involved, but we are not talking about the interest expenses. So this is also we are not concerned about it. Is it? Now we have only left two over. Yeah? We have profit before interest tax and capital employed. Capital employed is what? Capital employed is nothing but the total equity plus the non-current liabilities. Now what is more relevant here? The more relevant is lease is related to the non-current liabilities. Non-current liabilities is understated. Non-current liabilities is involved in the numerator as well as the non-current liabilities involved in the denominator. Of all the four ratios, which one is more effective? The impact is where it is the most impact. Impact is where there is an impact in the numerator as well as the denominator, because both are going to be understated. Is it clear? Little bit?
Yes.
Okay. What is the dividend yield? Is it right? What is the dividend yield? In the long questions, they will ask you this question. Is that this ratio is important? Is that this ratio is important? What is the dividend yield? Dividend yield. You have any idea about the formula about this?
No.
Dividend yield is nothing but dividend per share. Is it right? Dividend per share divided by current market price. Okay, current market price. We have dividends is there, dividend per share. They have profit for the year. They have share price. They have retained earnings. They have ordinary shares. Is it right? 1 minute, I'm just dividend per share. Retained earnings, profit for the year, how much? Two nine hundred minus 3300. Dividend per share. They have not given dividends. They gave you current market price 2.5. Is it? They gave you current market price is how much? 2.5. Is it right? 2.5. 1 minute. Retained earnings, profit for the year. Profit for the year. Where is dividends? Retained earnings, profit for the year. No, 330 divided by, no, we cannot put, they have to say how much they have paid dividends, is it right? Dividend per share is nothing but dividends paid, is it right? Dividends paid divided by now number of shares, is it right? Number of shares. Dividends paid divided by number of shares. Here, 1 minute. Data for question 8 and 9. Data for question 8, 9, 9. No, we need dividends, is it right? We need dividends paid, we need dividends paid. Maybe I am, while typing it from the textbook, I may have missed maybe 1 minute, okay? 1 minute. Just one, I will refer the